Hello everyone. In this presentation, I'm going to show you how to solve a capital budgeting problem. So here you are given a situation. So you need to figure out the pre-cash flows and then use any of these capital budgeting techniques, net present value approach or internal rate of return, whatever you would like to use. Just use at least two of them and find if this project is a good project or it's not a good project. Okay, so first of all, I'll start with some of the important things you need to consider. Okay, so number one, you're gonna be very careful at calculating depreciable basis. So that's the amount of the depreciation you're gonna be using. Initial cash outlay, so that's the amount of the money you need to put aside to run this project. Finding, calculating operating cash flows, and then terminal value. So these are the most important things you need to consider. Okay, so let me start with this problem. So in this problem, basically you have $450,000. That's the cost of the machine. So here I am doing this one equals to plus because I would like to know cost of the new machine, which is a depreciable basis. Okay, so that includes equipment, shipping, handling, installation, modification, anything associated with this machine. That's going to be included in the price of the machine. So that's going to be your depreciable basis. But if you remember from the textbook or from my lecture notes, do not include any uh, irrelevant cost on this project. Okay, for example, this $75,000 was spent on feasibility study. So things that like that, like historical cost or sunk cost, please do not include on the project. Okay, so first I calculated the depreciable basis. So basically I'm summarizing all the information on this input table. So depreciable basis is this one. In this case, we don't have any thing here is shipping, handling, installation. So $450,000 is a depreciable basis. Then next important thing is calculating change in net operating working capital. So basically when you install a new machine or when you carry out a new project, you need to put money aside or it's going to have effect on its operating capital. So basically here we have change in inventory, which is increase in inventory, so that's a plus. So increase in account payable, that's a minus. So increase in inventory minus increase in account payable, that's gonna give us change in net working capital. So in this case $40,000. I just summarize from here. Okay, so the third thing we're gonna see here is the effect on operation or revenue and in its cost associated with it. So here, as it's given in the question here, company will realize additional 600,000 in sale. So everything here we are talking about incremental. Okay, so that's additional sales revenue. Sometimes both of these sales revenue and the operating costs, they are, you are given the net. So increase in sale minus increase in the cost, so that's going to give you net. So basically that's the net effect of this project. Okay, so that's the your revenue, this is your cost associated with it. So sometimes you are given you know the summary of this one. And yeah, definitely life of the project very important, salvage value, and then the depreciation method. Okay, so here in this case we are using Makers. Okay, and other information you need to know the tax rate and then the cost of capital. Okay, so let me start with the nice table. I always like to have a flow of the information. Okay, if you look at the textbook, actually, it's kind of confusing. So I try to make it like logical information here, probably kind of accounting way. So please just follow this flow of the information. Okay, let me start with the initial cash outlay. So here my table runs from year 0 to all the way to year 4, but basically the project is ending in year 3. So I'm going to tell you the reason for this one, okay, later on. So most important thing, okay, so here cost of the new equipment, which is the depreciable basis, okay, so that's the money you need. Next is change in net working capital, so it's going to be coming here. So if you add two of these items here, I put both of them as a negative because it's cash outflow. So it's a 440 plus 450 plus 40,000 is 490,000. $490,000 is the total cash outlay for this project. In other words, you need $490,000 right now if you want to implement this project. In other words, that's the investment. Okay, so now let's go talk about the revenue side. Okay, so basically I'm gonna follow this one. Let me put this one because I think I missed that, so let me start this one with plus. Okay, so basically, so revenue is plus, cost is minus, depreciation is minus. So let's calculate EBIT, income before interest and taxes, in accounting terms. So sales revenue minus a projected increase in the cost minus depreciation, that's gonna give us EBIT. I would like to put all these number in positive and then just fix here. So projected sale minus projected increase in cost minus depreciation is equal to EBIT. Okay, so if you do in the Excel, so all you need to do is just drag the formula right here. Okay, so that's how you're gonna do calculate this EBIT. Now let me provide you a little bit insight about the depreciation. It's a pretty straightforward. So in this case, we have year 1 is 33%, year 2 is 45%, year 3 is 15%, and year 4 is 7%. Okay, so how do I get this number? This number is basically depreciable basis. Okay, so which is this one, or in other words this $450,000. So let me just click here and show you. Okay, this one is just randomly showing this one, so please ignore that. This is basically this $450,000, which is depreciable basis. Okay, so here is this depreciable basis. Okay, I would like to control this one, so I would like to put a dollar sign in front of it because I'm going to use that number for, so let me put manually here dollar sign. So I'm controlling this $450,000 as I'm moving, and then multiply by the depreciation rate. Okay, so you got this value here. It's a, I would like to put plus still, so I would like to put a minus sign in the front. So $448,000. Okay, now the next number here is the same way, so let me just drag the formula. Okay, so here the depreciable basis times the MACRS rate for second year. Okay, I'm gonna do until the fourth year. The reason for that is the project ends in year 3, so whatever left over in year 4, that's your book value of the machine. Okay, and we need that number later on when we calculate terminal cash flow. Okay, so right now let's just concentrate on this one. So EBIT, sales minus projected increase in cost minus depreciation, that's gonna give you EBIT. Okay, just follow the sequence here. And now let's calculate the tax. So take out the tax from income before interest and taxes. Our tax equals to this number, okay, which is EBIT times our tax rate. Tax rate is 40%. Okay, so I'm gonna drag this information right here. Okay, so this is our tax, and again I'm not putting the sign here. I'm using everything is positive, but since this number is negative, you see this one is negative. Okay, so now we calculated income taxes. Now let's find out NOPAT, which is net operating profit after tax. Okay, so following this sequence, EBIT minus taxes. Okay, EBIT minus taxes. Here we have 30,900. Okay, and I'm gonna just drag this formula here. Okay, so I calculate NOPAT, net operating profit after tax. You might be thinking, what is this interest? Basically in finance, this cost of capital already includes that the effect of interest expense, so we don't take out interest expense here. This one is already considering that factor, so we don't do like interest expense like accounting people do. All right, now we calculate NOPAT. If you remember, we took out the depreciation. So let me just put simply, in finance, depreciation is not the cost, it's just the tax advantage. Okay, so when you calculate free cash flow or operating cash flow, we need to add it back once we calculate the tax. Okay, so we're gonna put that depreciation, just copy this number from here. Okay, so copy these numbers from here, put back depreciation. Now operating cash flows, operating cash flow equals to NOPAT plus depreciation. So let's do this one, NOPAT plus depreciation. Okay, now drag this all the way to the year 3 because we have 3 years. All right, so this is calculation of operating cash flow. And if you remember, terminal value is another important things we need to know. All right, so terminal value equals to the value of this project when you terminate it. Okay, so if you terminate this project at the end of the year 3, so what's gonna happen? Just let's think about it. If you remember, we put net working capital aside to run the project, right? So whenever you end the project, you don't need to put that money aside anymore, so you can get that money back. That's why I put this plus sign. All right, what else? Now you have the machine or the equipment. You can sell this machine or the equipment, and that value is given here in the question. It's the salvage value is $50,000, right? So we put that plus here, $50,000. Now this is a simple project. You could have some more items here, but in this case we have only these two. Now if you sell the item for $50,000 in the business, you have to pay tax, right? On your sale you have to pay tax on it. So basically $50,000, take out the tax. So taking out the tax is a little bit complicated. Okay, so you don't pay tax on the salvage value, but you pay the tax on the difference between salvage value and the book value of the machine. So you have the book value is 50,000, but sorry, you have the salvage value, which is you are the projected value of the machine. You may sell it for $50,000, or you are going to sell for $50,000, but this machine has the book value of only $31,500. Okay, so find the difference between these two and multiply with the tax rate. Okay, multiply with the tax rate here. Okay, so let me simplify here. I'm gonna do the difference between the book value, sorry, the salvage value minus the book value. Okay, and then I'm gonna multiply by the tax rate, which is 40%. Okay, so it's gonna give me the salvage value, tax on the salvage value. Okay, now again I'm gonna just follow this sequence. All right, so what I'm gonna do here is I'm gonna follow these signs here. So this value plus this value minus taxes on the salvage, on the gain on the sale. So basically gives me 82,400. Let me show you a little bit, because this part is complicated, so I have done some work here. Book value is the cost basis minus accumulated depreciation. So basically the accumulated depreciation is, if you sum all of these, that's going to be your accumulated depreciation. Okay, if you do that, you don't need to put that year 4. So that's going to be your accumulated depreciation. So here $450,000 minus 418,500, that's going to give you 31,500, which is equal to this year 4 depreciation. Okay, so basically you don't need to do this extra work. You can just create extra column here, and then that's your the 4th year depreciation is basically your book value. So now gain, calculating gain or loss on the sale, or the salvage value, which is salvage value minus the book value. So the salvage value is given 50,000, and then the book value is 31,500. So the difference is 18,500. So taxes on salvage value here, taxes on tax on the salvage value equals to gain or loss on the sale times the tax rate. So 18,500 times 40% equals to 7,500. That's what I have here. So hope this information given here helps you to determine this part. So if you can do this much, I think this project is pretty straightforward and easy. Okay, now let's do the final part of this project. Now let's calculate the free cash flows. It's straightforward. Initial cash outlay. Okay, that's the money you're going to put aside when you start this project. And then the first year, the free cash flow is basically equal to operating cash flow. Second year, same as the operating cash flow, only the difference here is the final year. So in final year, we're gonna add basically we're gonna do this one here, operating cash flow plus terminal cash flow, and that's gonna be our final year or third year free cash flow. Okay, so now it's pretty easy here. You already got your initial cash outlay and then the free cash flow for next few years, 3 years. Okay, it's just like your capital budgeting problem now, because on your capital budgeting chapter you are given these values. So basically you are not given all of these, so it's easy. You always find this chapter very easy, but when you have this all this projection, that is the complicated part. So here we're gonna do NPV in Excel. NPV basically equals to, you start equal sign and you start with the parenthesis and put the rate, and then select the values, the free cash flows for year 1, 2, 3, close the parenthesis, and then we gonna do minus, but this number is already minus. Okay, so we put plus here. Okay, so here is our net present value. our internal rate of return here equals to you start with IRR and then select all the values here, and then this is your internal rate of return. Okay, if you want to do modified internal rate of return, the same, that's easy. So here MIRR, and you select the values, and then you gonna select the finance rate, so which is basically required rate of return, and then we assume your reinvestment rate also is the same as the cost of capital. Okay, so here uh, again, and then you close the parenthesis, so we have 10.7%, and profitability index is basically your net present value, actually the um, present value divided by the cost. Okay, so what I did here is eh, find out the present value. If I do NPV and then just like you did NPV but didn't take out the cost, is going to be present value, and you your divide by your um, cost, which is 490,000. That's gonna give you profitability index. So I use these four criteria. Okay, so basically, if you do one or two, you will be fine. So from your capital budgeting capital budgeting chapter, if you remember, since this project has the positive NPV, so the project's NPV is greater than zero. In this case, based on NPV, we accept this project. If you want to use internal rate of return or modified internal rate of return, you compare with your cost of capital here. So your cost of capital is 9.5%, but your internal rate of return is 11.3%. Therefore, this rate of return, internal rate of return, is higher than the cost of capital. So using internal rate of return criteria too, you're gonna accept this project. Okay, so this is how you're gonna do. So my final thing to say here is, please follow this sequence here. Okay, or this, in other words, the formula here, and calculate these cash flows. Okay, and then use NPV or internal rate of return, and find if this project is acceptable project or you cannot accept this project. Okay, hope this helps you. If you have any questions and comments, please let me know. Thank you.